This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Alright, this is the third lecture on Section A of the September 2016 Paper F9 exam. And if you've watched the previous two, you'll know I'm going through 5 at a time. So the first lecture we went through questions 1 to 5, the second I went through 6 to 10. And so the last one, will go through questions 11 to 15. We'll finish it off. So let's make a start. Number 11. This is one, I know I've been saying this all the way through, but this is one I would jump over, to be honest. It says, what's the current market value of a convertible loan note? And the thing is, although I like this a lot, this is involving quite a bit of calculation. Inevitably, this is going to take longer than most of the others. And so, although I like it and I'm quite confident I can do it, I would leave it and look. I think there are a few more very quick ones later on. I'd get them out of the way first and then go back and spend the time needed on number 11, because there's still only 2 marks. But let's do it. Lane Co has in issue 3% convertible loan notes, which are redeemable in 5 years' time at their nominal value of 100. Alternatively, each loan note can be converted in 5 years' time into 25 Lane Co ordinary shares. Now, you should be more than happy that the market value of debt, loan notes, bonds, whatever, it's the present value of the future expected receipts discounted at the investor's required rate of return. Now, as I said earlier, rate of return. I said earlier, don't write all that down in the exam. Nobody looks at your workings for section A. But always market value, present value of future expected receipts, discounted investor's required return. And the problem here, because they're convertible, is what are the expected receipts? We know they're going to get interest each year at 3% for 5 years. But the first thing we need to sort out is what are they expecting they'll receive in 5 years' time? Because there is going to be a choice of whether to take cash or shares. Now, although they won't have to actually choose until 5 years from now, today's market value is based on what they expect they'll be doing. And so that's the first bit. We have to sort out, are they going to convert or not, or do they expect to? And of course, if they don't, one option, they can just take the cash. And on $100 nominal, the redeemable at nominal value, so it would be cash of 100. Or if they convert, they'll get shares. And it says each loan note can be converted to 25 shares. And how much do we expect these shares will be worth? The current share price is $3.60. But we're expecting growth to be 5% a year. So in 5 years' time, well, multiply by 1.05 each year to grow it, to inflate it, to the power 5 for 5 years. And so what do they expect the shares will be worth? $114.87. And so what do they expect they're going to do? Clearly, because it's higher, they expect will convert. So now we can set up the expected receipts. And $100 nominal, which is what we're asked for. What are they going to get? Well, they're going to get interest for 5 years, 1 to 5, at the coupon rate 3% on nominal, which is $3 per annum. And it's only the first of 2 vital things in relation to tax. Remember, it's investors who fix the market value. And so it's the receipt to investors. Investors aren't affected by corporation tax at all. They will receive the full interest of $3. It's the company who gets the benefit of tax relief on interest, but that's irrelevant. For the investors, they'll get the full $3. In addition, though, in 5 years' time, we've decided they'll convert, and so they expect to receive effectively 114.87. Market value is the present value of those receipts, discounted at the investor's required return, and the return to investors is before tax. I hate the way he writes this, before tax cost of debt. It's a horrible way of writing it. You see, the cost of debt to the company is after tax, because the company gets tax relief on its borrowings. But it's the investors who fix the market value, and the return to them is before tax. The corporation tax is irrelevant. And so we discount at 10% the return to investors. So it's now straight discounting. The interest, 5 years, it's the 5-year annuity factor at 10%, which is 3.791. Now the conversion, the ordinary discount factor for 5 years at 10% is 0.621. And so the present values, 3 times 3.791, 11.37, 114.87 times 0.621, 71.33, gives a present value, therefore a market value for $100 nominal of 82.70. Where are we? If you look at the choices, actually I think my answer is more correct than the examiner's. The answer is obviously A. The 1 cent difference is just purely rounding. But it has to be A. I think obviously the others are miles away, so there we are. So again, I think that's a nice one, but it's certainly a long one. And much longer than some of the others, and still only 2 marks. Anyway, let's move on. What about number 12? According to the 4-way equivalence model, which of the following statements are true? And what are we told? Country X uses the dollar as its currency. Country Y uses the dinar. Country X's inflation rate is 5% compared to 2% in country Y. Country Y's nominal interest rate is 4%, and the nominal rate, remember, it'll be relevant later, nominal interest is the actual interest rate that there is in here, country Y. And finally, the current spot exchange rate is 1.5 dinar to the dollar. And there are 3 statements there. I want to know which of those statements are true. Well, I'll do them in reverse. I'll start with number 3. Country X's real interest rate should be higher than that of country Y. No. The actual interest rate in any country, the nominal rate, well, the higher the inflation, in theory, the higher the interest. So the actual interest rate will be higher and lower with the rate of inflation. But in theory, the real interest rate, well, the real interest rate is the interest rate if we take out inflation. If there was no inflation, in theory, real interest rates should be the same. It's the actual interest rate which will be higher or lower depending on higher or lower inflation. So 3 is not true. Nominal interest rates should be higher in the country with higher inflation, but real interest rates should stay the same. And so immediately I know the answer has to be A or B. You know, as I kept saying, if you don't understand the others, you get stuck. If you're guessing, at least you have a 50% chance now of getting it right. Anyway, let's look at number 2. The future expected spot rate after 1 year should be 1.4571 dinars per dollar. This is surely purchasing power parity. We know what the current spot rate is, 5000. The forecast rate in 1 year, and I hope you've watched the lecture, because this is then easy, using purchasing power parity, it's we multiply by 1 plus the inflation rate in the other country and divide by 1 plus the inflation rate in what I call the base country. Well, here, because the exchange rate is quoting dinars per dollar, dollar is what you might call the base country, where the inflation rate is 5%. So 1 plus inflation, 1.05. The other country is dinar, which is Y, where the inflation is 2%. And so the forecast exchange rate is 1.4571. And is that what it said? Yes. So number 2 is correct. And now just look at the choices. I know 3 is not correct and 2 is correct. And so in fact, there's only one available. If 2's correct, it has to be B. And bear that in mind in the exam, because although I'm going to talk through the remaining one, you know, don't waste time. If you've finished all the other questions, you can come back and then check it. But the answer has to be B. Anyway, let's look at 1. The country X's nominal interest rate should be 706. Now, the nominal interest rate is the actual interest rate, and I've said several times, you know, in Y, actual interest is 4%. Well, X has higher inflation, and therefore X should have a higher interest rate. So certainly X, the actual interest rate will be higher than 4, but that doesn't prove that it's 7.06. But it's interest rate parity, effectively, that the interest rate in dinars is 4% up at 1.04. The interest rate in X, therefore, should be 1 plus the inflation in X over 1 plus the inflation in country Y, which is 1.05 divided by 1.02 times 1.04. It's 1.0706 is 1 plus the interest rate in, we'll switch country X, I think. So the interest the nominal interest you'd expect to be 7.06%. And is that what it says? Yes. So the actual interest in country X should be, in theory, according to all the theory, should be 7.06%. So 1 is indeed correct, but as I said, we already knew the answer was going to be B. Number 13, a little bit of economics, but I don't think, if you understand the words, I don't think you need to know much about economics to be able to get this right. Which of the following government actions would lead to an increase in aggregate demand, total demand? Demand within the country, people spending more, buying more. Which of those 4, or which combinations of them, would result in an increase? Number 1, increasing tax and keeping government expenditure the same. Well, that's not going to help. Surely increasing tax, people have less money to spend. That won't increase demand. Number 2, decreasing tax and increasing expenditure. Yes, there's more money in the economy. Decreased tax, people have more to spend. Government spends more, there's more money going round. 3, decreasing money supply. Well, if they cut the amount of money that's in the country, clearly, I would have thought, people have less to spend, there's less demand. No. 4, decreasing interest rates. Yes. If interest rates fall, it's easier, cheaper rather, for people to borrow money. Paying any interest on existing borrowings gets less. It's a way people will have more money to spend. So it's 2 and 4. It's C. All right, nearly there. 14. What is Peach Company's return on capital employed? Well, good heavens. You know, I don't know how many people would have got as far as this in the time. But if you'd been jumping, like I said earlier, you'd have come to it. And I mean, I say good heavens because return on capital employed, it was testable at F5, it was testable in F2 and F3. You should have seen that in so many places. This really should be automatic. The return on capital employed is the profit before interest and tax as a percentage of the total long-term finance of the company, which is equity plus long-term debt. So look at the information. This couldn't have been made easy. It really couldn't. Profit before interest and tax, 2,500. It's in thousands, but not worried there. And the statement of financial position, the total long-term finance, equity 10, non-current liabilities 2.5, so 12.5. And what does that come to? 2,500 divided by 12,500. 0.2, 20%. Yes, C. So I don't think there's anything else to say there. We threw a few other figures in to try and confuse profit after tax, profit before tax, so on. Well, if you haven't learned return on capital employed, I think it might be a good idea if you did. Finally, number 15. What is the theoretical value of a right per existing share? Very, very standard here. Just make sure, you'll see as I go through, that you don't lose silly marks in misreading. But otherwise, this really is something you should have learned. Drumlin has 5 million of 50-cent nominal value ordinary shares in issue. It recently announced a 1-for-4 rights issue at $6 per share. Its share price on the announcement of the rights issue was $8 per share. Well, the theoretical value of a right. First of all, we need to know what the X rights price is, the theoretical X rights price. I know some of you may have learnt a formula. If you have, fine. What I always do, well, it's 1-for-4. So I say if somebody had 4 shares at the moment, the current market value of them is $8 each, so they'd be worth 32. It's a 1-for-4 rights issue, so they could buy 1 more, and they'd have to pay $6. And so the theoretical X rights price must be such that there's no gain, no loss. They'll end up with 5 shares, a total of 38, and therefore, for no gain, no loss, the theoretical price, 38 over 5, is $7.60 per share. No gain, no loss on the existing shares. They're losing 40 cents. The value goes down. But the rights, they're paying 6 and it's worth 7.60. They're gaining 1.60. So the overall effect, no gain, no loss. However, they didn't want simply the theoretical X rights price, and thankfully it's not one of the choices. I'm surprised, because if that had been one of the choices, a lot of people would have ticked it. But they want the theoretical value of a right. So how much is a right worth? Well, the theoretical price is $7.60. How much did they have to pay to take up the rights? $6. And so if they don't want to take up the rights, they can sell the rights. The rights themselves are worth $1.60. So they can sell the rights letter. It'll be $1.60 per share. Now that is one of the choices, but do be careful here. That is the value of a right per new share. So for every new share you're offered, you can sell the rights for $1.60, but that's not what's asked for. It's the value per existing share. So to get that one right, how many existing shares did you need? You needed 4 existing. And so if it's $1.60 for every new share, the value per existing share is $1.60 divided by the 4 we needed, which is 40 cents. The correct answer is B. And it's such a shame for people who answered A, because they obviously knew what they were doing. They just hadn't read it carefully enough. There's no half marks. Anyway, there we are. We've been through all 15.